Hello, I'm James Yardley, Senior Research Analyst at Caliber, and today I'm joined by Anthony Cross, the elite rated manager of the Liontrust Special Situations Fund. Thank you very much for joining us, Anthony.
Morning, good to see you.
And you mentioned distribution networks. Can you give us some practical examples of these?
Yes, so distribution networks are fascinating because there's two types of network that we look for. The first is in many ways, the most obvious, and those are the large-scale distribution networks that companies have built up, often over many years. So, at the very big level, think of companies like Unilever or Diageo with huge global networks, and those networks have been built up often over hundreds of years. They have terrific amounts of sunk cost have gone into developing them, not only in terms of sometimes physical assets in those distribution networks, but also importantly for us, they've spent a huge amount on developing their brands. Lots and lots is being spent on marketing. And they also have deep local supplier and local regional relationships with both suppliers and obviously consumers. So those big scale distribution networks, we think, provide a strong barrier to competition. And it's no surprise that you do see the likes of Unilever or Diageo buying up smaller brands that have perhaps got a bit of a foothold in a certain market, and then being able to take those brands and drive them through their global networks. And we think that's it's very powerful for those companies, and they have those strong barriers to competition. The second type of distribution network we like is the much more modern data-driven networks that you find with often software companies or media businesses or sometimes financial service companies, where that distribution network is really invisible because it's actually all about data and software. So Rightmove is a very good example of a very invisible but very strong distribution network. And we like these data-driven networks because they are often embedded within their end customers. And that they might be embedded within us as consumers, or they might be embedded within other businesses. But these embedded distribution networks are extremely sticky. They're difficult for competitors to come along and drive a business out once it's embedded within their end customer. And we all know how reluctant we are, either as business owners or as consumers, in changing our software providers or data providers. It's often very difficult and time consuming. So embedded distribution networks we think are very valuable. And they're often established with pre-agreed pricing. So these sort of companies are not subject to such aggressive retendering all the time in terms of procurement. So we like those embedded distribution networks. We think they're very valuable. And we have lots of those in terms of software and media companies and financial service businesses within the funds.
And how has the process held up during the pandemic? Have your recurring revenues continued as you would have expected, for example?
Yes, the process has held up pretty well. So, tumbling out of the sorts of companies we own, there are definitely sectors where you'll find us more exposed to than others. So we have lots of industrial companies. We find lots of intellectual property and distribution power in industrial businesses, companies like Spirax-Sarco or Renishaw. We have the big consumer goods companies. I've mentioned Diageo, Unilever, but there's also companies like Reckitt within the fund. We also have some of the big healthcare companies, so GlaxoSmithKline and AstraZeneca, and also lots of software companies with recurring income, some media businesses and fee-based financials with recurring income. And we also own the two big oil companies, BP and Shell. So as we went into the pandemic, the areas that got hit hardest were certainly the banking sector, and we don't own any retail banks. And also the classic people-to-people cyclical consumer stocks in the UK, where we have little exposure. So we don't own, say, in our Special Situations Fund, we don't own any sort of high street retailers. We don't own any bar or restaurant companies. So we found that we were underexposed to some of those businesses that were sadly suffering a lot from the lockdowns. So in the first phase of the pandemic, we outperformed the market quite strongly. Our industrials fell quite heavily, but we were less exposed to those areas of the market that fell the hardest. And then in the second phase, as the market bottomed and then started to grind up towards November, Again, we were ahead of the all-share. We found that our industrial companies bounced quite heavily, and a number of our AIM companies, alternative investment market companies, such as Gamma and such as YouGov, performed strongly. So this was our sort of software, technology, media businesses continue to perform strongly, and they saw good underlying demand for their products.
What does Gamma do?
Yes, Gamma is a telecommunications business, and it's at the forefront of some of the more forward-thinking, modern pieces of telecoms that we all are increasingly using. So at one end, it might be increasing exposure to areas like Microsoft Teams, but also much more of the digital of communications that we are now all adopting, particularly as businesses. And their competition is much more than the older, sort of more analog type businesses like British Telecom. And Gamma doesn't have the older networks that BT are having to sort of almost cannibalize within their own business to roll out the newer networks that are becoming much more important. So Gamma has been at the forefront of helping businesses with new telecom systems, and they're also benefiting from a very strong sales structure and culture within the business. So it's been a very good long-term compounding business for us. They have a strong foothold within the UK, and they're now expanding outwards within Europe. So that sort of business has actually had a relatively good pandemic because of telecoms communication needs have obviously held up strongly during the pandemic.
And you mentioned BP and Shell. What intangible assets do they have? I mean, are these not businesses in a dying industry? How can they do going forward?
Right. So a couple of questions there. First of all, what intangible assets do we see in those businesses? We think there's very strong intellectual property within those companies, and the companies themselves don't talk strongly enough, we would argue, about the intellectual property that they have. They are big investors in research and development. They're heavily patented businesses, and they're also businesses with a terrific amount of know-how within their areas of expertise. So you take, BP and exploration. They have strong refining know-how, and they also have built up strong brands within their refining products too. They also have, importantly, very strong distribution networks. So if you look at Shell, for example, it's got the biggest liquid gas distribution network in the world. They are in the top 3 energy trading businesses in the world. Shell is actually the biggest retailer in the world, maybe not the most exciting shops, but in terms of retail footprint, they are the biggest retailer in the world. And these distribution networks, we think, and their intellectual property will be very important going forwards in energy transition. So answering the second part of your question, are they relevant businesses going forward? We would argue absolutely yes. For a while, we'll still need the old hydrocarbons, but hopefully over time, and there's strong emphasis from government and consumers to make this change, we will make the change. There will be energy transition over towards much more renewable energy forms, whether it could be areas like solar, it could be wind, it could be hydrogen. But in all these areas, BP and Shell have a very strong level of distribution power, intellectual property, balance sheet, cash flow, to enable them to invest in these areas and become a very important part in this energy transition. And this is what the companies are already doing. And they have set some strong goals for their own performance in terms of energy transition. And they're also out there helping companies, helping governments make that change. So we think they're going to be a very relevant part of energy transition going forward. And they're not expensive businesses. So, they are the sort of companies that we could see actually performing quite well for us in our portfolios over the next 5, 10, 15 years.
And your fund is multicap. I think you have roughly a third in large, mid, and small cap at the moment. Where are you seeing the best opportunities at the moment?
Well, we see them really right across the market. And if you're looking at small cap companies, we love small cap companies. We spend a lot of time looking for them and researching them. We're a team of 5 in our particular funds that we look after. And we have a micro cap fund, we have a small cap fund, we have the Special Situations Fund, which is right across the market. And we have the UK Growth Fund, which is more FTSE 350. But we do have that expertise in small cap, and the ideas are flowing through all the time from our microcap fund into our small cap area and up into special situations. So we're capturing these businesses at an early stage and following them and owning them. And that's very important, we think, particularly in small company investing, is having that deep knowledge about a business is very, very valuable. So we're always, hugely supportive of small companies. And it's always a joy if you can find a small company which hasn't been completely understood by the stock market, because you can enjoy that re-rating, the expansion of the PE as the company becomes better known. And we have that effect very strongly occurring in our microcap fund. So we'll always enjoy having small companies within our funds, and special situations will aim to have at least 20% in smaller companies. And we're finding opportunities right across the sectors that we would typically be looking at, media, software, fee-based financials. Lots of companies fit the bill there. Some of them are quite expensive, but they are compounding strongly, so they can erode that expensiveness over time. Moving into mid-cap, here we have a lot of industrials that we really like. So companies like Spectrus, Rotork, Renishaw has actually just moved up into the FTSE 100. These industrial businesses with strong distribution networks and lots of intellectual property have been really good long-term winners for us. I've been investing in Spirax Sarco and Renishaw, now both FTSE 100 companies, but I started investing in those businesses when they were small cap companies. So they can travel a very long way. And then as you look up into the FTSE 100, often your growth rates are slower, but then your valuations are less as well. So, we have companies, as we've spoken about, like the big oil companies, also companies like Glaxo and AstraZeneca, and also the big consumer goods companies. So Unilever, Reckitt, Diageo sit within that area. Sometimes also we'll find strong service businesses. So we have a business like Intertech, which is a testing business. And that's a company that, again, has got a very strong global network.
Thank you very much for joining us. If you'd like to learn more about the Liontrust Special Situations Fund, please visit fundcalibre.com.